Reporting requirements. By the time a real estate transaction reaches closing, it is easy to feel as if every possible document has already been signed. But the law does not stop at the closing table. Certain tax and reporting requirements continue beyond the settlement statement, and as a real estate professional, you need to understand who reports what, when, and why. In this section, we connect three big ideas: federal income tax reporting on real estate sales, special withholding rules when a foreign seller is involved, and the recording of documents in the public record to give the world notice of ownership and liens. Together, these requirements help the government track taxable events, protect the tax base, and give buyers, lenders, and the public a reliable way to determine who owns what. Who must report real estate transactions? The Tax Reform Act of 1986 requires that most real estate sales and certain exchanges be reported to the Internal Revenue Service on an information return. The law groups a variety of parties into the category of real estate broker for this purpose. That definition is broader than a licensed salesperson or broker alone. In practice, any of the following might be designated as the reporting person: the listing broker representing the seller, the broker representing the buyer, the settlement or escrow agent, the attorney who conducts the closing, the title company that handles settlement and recording, or even the mortgage lender in certain structures. The IRS may also specifically designate another party. In many modern residential transactions, especially in escrow states like Arizona, the title or escrow company typically assumes the responsibility for filing the required form, but the duty still exists under federal law, whether the parties recognize it or not. In addition to reporting the sale itself, brokerages have separate obligations when they pay commissions to other brokerages or to independent contractor agents. When a brokerage pays a co-broke or pays non-employee agents more than the threshold amount in a year, it generally must issue an information return, such as Form 1099 NEC, that reports those payments as non-employee compensation. The point is that the government wants to see both sides of the transaction: the sale proceeds that might create a taxable gain for the seller, and the income paid out in commissions that is taxable to the recipient. Real estate professionals do not need to memorize all IRS form numbers, but they do need to recognize that their brokerage operations and closings are watched through these required reports. What must be filed? Form 1099S and related information. For most reportable transactions involving the sale or exchange of real estate, the reporting person must file Form 1099S with the IRS. This is an information return that does not itself calculate tax. Instead, it tells the IRS that a taxable event has occurred and gives the basic details. The form includes the names, addresses, and taxpayer identification numbers of the parties, a description of the property, the date of closing, and the gross proceeds paid to the seller. It may also indicate whether the seller received any property or services instead of cash, and whether any real estate taxes were paid by the purchaser that are to be treated as gross proceeds to the seller. The reporting person must also provide a written statement to each transfer, typically the seller, showing the same information reported to the IRS, along with the name, address, and contact information of the reporting party. This ensures that the seller knows exactly what has been reported and can use that information when preparing their own tax return. Some transactions may be exempt from Form 1999S reporting, such as certain sales of a principal residence where the seller certifies that the gain is excludable under the principal residence exclusion rules. In practice, the settlement agent or title company will typically obtain a certification from the seller at closing and decide whether to file the 1099S based on that certification and IRS rules. Special reporting and withholding for foreign sellers, FIRPTA. Ordinary U.S. sellers are expected to self-report their taxable gain when they file their annual returns. But Congress was concerned that foreign owners might sell U.S. real estate, take their proceeds out of the country, and never file a U.S. return. To address this, the Foreign Investment in Real Property Tax Act of 1980, known as FIRPTA, created a special withholding regime. Under FIRPTA, the disposition of a U.S. real property interest by a foreign person is subject to income tax withholding. A U.S. real property interest includes more than just a fee simple home. It can also include an interest in a U.S. corporation that primarily holds U.S. real property. The default rule is that the transferee, usually the buyer, must withhold a percentage of the amount realized, generally the gross sales price, and remit it to the IRS. Today, that standard rate is 15% in most cases. This is not the final tax. It is a prepayment or deposit against any capital gain tax the foreign seller will ultimately owe. The buyer is usually the withholding agent. That means, if you are representing a buyer purchasing from a foreign transfer and you ignore FIRPTA, there is real risk. If the required withholding is not made and the foreign seller disappears without paying tax, the IRS can pursue the buyer for the unpaid amount, plus interest and penalties. In actual practice, the settlement or title company usually handles the mechanics of withholding and sending funds to the IRS, but the legal obligation to make sure it happens falls on the transferee. FIRPTA exceptions and practical scenarios. There are important exceptions to FIRPTA withholding, designed to avoid burdening ordinary homebuyers in smaller residential transactions. One common exception applies when the buyer acquires the property for use as a residence and the sales price does not exceed a certain threshold. For properties at or below a lower threshold amount, no withholding may be required if the buyer signs an affidavit that they or a family member will use the property as their primary residence. For certain mid-range prices, where the buyer will occupy the property, a reduced withholding rate can apply. The exact dollar thresholds and rates are set by statute and can change, so agents should always encourage clients to confirm current rules with a tax professional or the settlement agent. Even when withholding applies, foreign sellers are not powerless. There are two main approaches they can use. One option is to allow the standard amount to be withheld at closing, and then file a U.S. income tax return for the year of the sale, reporting the actual gain or loss. If the 15% withholding exceeded the true tax liability, the seller can claim a refund when that return is processed. This approach can take many months because the seller must wait until the following filing season. The second option is to apply in advance for a withholding certificate from the IRS that authorizes reduced withholding based on a more accurate estimate of the tax. This application must be made on or before the date of closing and must include the legal names, addresses, and taxpayer identification numbers for all buyers and sellers. If any parties do not yet have U.S. taxpayer numbers, they must submit complete applications for those numbers with the withholding application. While the IRS reviews the application, the withheld funds typically remain with the closing agent, instead of being immediately sent to the IRS. Once a withholding certificate is issued, the settlement agent can release any excess funds to the seller. Even after obtaining a withholding certificate, the foreign seller must still file a final U.S. return for the year of sale. As an agent, you are not responsible for preparing FIRPTA forms, but you play a key advisory role. If you suspect that a seller might be a foreign person under U.S. tax law, you should immediately raise the topic with the settlement agent. Suggest that the parties seek tax advice and make sure the purchase contract is clear about who will handle withholding obligations and how. Buyers and foreign sellers both need to understand that FIRPTA is not optional and that ignoring it can delay closings or create serious tax exposure. Why real estate documents are recorded. Tax reporting tells the government that a transfer has occurred. Recording tells the world which rights have been transferred. To see why this matters, imagine a simple story. Billy buys a home, moves in, and proudly declares that it is his house. A week later, while he is away on vacation, Sarah moves in and declares that it is now her house. Unless Billy has more than his voice to back up his claim, the dispute could become a legal mess. In the real world, we avoid this chaos through written instruments and public recording. When someone sells real property, they sign a deed that transfers their ownership rights to the buyer. A deed is a written, signed legal document that describes the property and clearly identifies the grantor, seller, and grantee, buyer. After signing, the deed is delivered and then recorded in the county where the property is located. Most states divide their territory into counties, and each county has an office responsible for keeping land records. The office might be called the county recorder, recorder of deeds, county clerk, or registrar. Regardless of name, its job is to accept qualifying documents, record them, index them, and preserve them as part of the public record. In addition to deeds, many other documents that relate to rights in real property are recorded. Deeds of trust and mortgages give lenders a security interest in the property. Assignments move that lender's rights from one institution to another. Releases, satisfactions, and reconveyances prove that a debt secured by the property has been paid and that the lien is no longer valid. Powers of attorney may be recorded when someone signs for another in a real estate transaction. In some counties, there are also recorded subordination agreements, UCC filings, and notary commissions. How recording works and what it does and does not prove. Before a document can be recorded, it must meet state and local requirements for format and content. There is usually a recording fee and sometimes a transfer tax that must be paid at the same time. The person or company that submits the document for recording is called the document submitter. This might be a property owner, attorney, title company, or escrow agent. Once accepted, the recorder's office stamps the document with the date and time of recording, assigns it a unique identification number, and enters it into an index, often organized by grantor and grantee names, document type, and recording date. These records can then be searched by any member of the public, either in person or via an online system. After recording, the original document is returned to the submitter, and a copy remains in the public archives. Recording provides what lawyers call constructive notice. That means that once a document is properly recorded, the law treats everyone as if they know about it, whether they actually went to the recorder's office or not. If Billy's deed is recorded, then anyone later buying from the same seller is considered to have constructive notice that Billy already owns the property. The recorder is not, however, responsible for policing the truth of the content. If someone manages to record a forged deed or a deed obtained by fraud, the recorder does not guarantee its validity. Instead, those issues are resolved in court. The recorder's duty is to accept documents that meet formal requirements and preserve them in proper order. Priority rules: notice, race, and race notice statutes. Because documents are recorded over time, there must be some rule that determines which recorded interest has priority when there is a conflict. States generally use one of three systems: race, notice, or race notice. These labels can be confusing, but the basic reasoning is straightforward. Imagine that Sam signs a deed conveying the same property first to Billy and then 1 hour later to Sarah. In a pure race state, priority goes to whichever grantee records first, regardless of who got their deed first or who knew what. If Sarah records her deed before Billy, even though hers was signed second, Sarah will usually prevail because she won the race to the recording office. The system rewards speed and simplicity. First to record wins. In a pure notice state, the key question is whether a later purchaser had notice of an earlier unrecorded interest at the time they purchased. If Billy receives and records his deed, and Sarah later buys without knowing about Billy's deed, the law asks whether she had actual or constructive notice. Actual notice means she was directly told about Billy's interest. Constructive notice arises from the presence of Billy's deed in the public record for a reasonable time before her purchase. If the court finds that she reasonably should have found Billy's deed in the record, she may lose priority even if she recorded her deed. In a race notice state, both elements are required for the later purchaser to win. The later purchaser must record first and must also be without notice of the prior unrecorded interest at the time of purchase. That means a later buyer cannot simply sprint to the recorder's office if they already know about an earlier deed. They must be a good faith purchaser without notice and must win the race to record. The details vary by state, but the underlying purpose is the same. Encourage prompt recording and protect good faith purchasers who rely on the public record. As an agent, you will not be expected to apply these statutes in court, but understanding why prompt recording matters helps you counsel clients. It is not enough to sign a deed. It must also be recorded promptly and correctly to protect the buyer's priority and put the world on notice. Review summary. In this section, you learned that closing a real estate transaction is not just about delivering a deed and collecting a check. Federal tax law requires that reportable real estate sales and exchanges be disclosed on information returns, such as Form 1099-S. The real estate broker responsible for filing may be the listing broker, buyer's broker, settlement agent, or title company, depending on how the transaction is structured. Brokerages also have separate obligations to report commissions paid to co-brokers and agents on information returns like Form 1099 NEC. You also learned that when a foreign person sells a U.S. real property interest, FIRPTA requires the buyer, as withholding agent, to withhold a percentage of the gross sales price and remit it to the IRS as a prepayment of the seller's tax. Exceptions exist, especially for certain owner-occupied residential purchases under specified price thresholds. But the rules are technical. Foreign sellers can accept standard withholding and seek a refund later through a tax return, or they can apply for a reduced withholding certificate before or at closing. Either way, FIRPTA compliance must be considered early in the transaction to avoid surprises and delays. Finally, you examined why recording is essential to the real estate system. Recording deeds, mortgages, satisfactions, and related instruments at the county recorder's office gives constructive notice to the world about who owns the property and what liens or interests affect it. The recorder's job is to maintain a chronological, indexed record. The recorder does not guarantee that every document is honest or lawful. Priority disputes between competing claims are decided under state rules, known as race, notice, or race notice statutes, all of which reward prompt recording and protect good faith purchasers who rely on the public record. Discussion: a seller asks you if they can skip the IRS paperwork on a small home sale because they believe their gain is fully excluded as a principal residence. How would you respond while keeping your role as a real estate professional and not a tax preparer? Suggested answer: you could explain that federal law requires certain real estate transactions to be reported to the IRS on forms like 1099-S, and that the settlement agent or title company typically handles that reporting. Whether or not the seller actually owes tax or qualifies for a principal residence exclusion is a question for their tax advisor, not for the real estate agent. Skipping required reporting is not an option. Instead, the seller can work with their tax professional to claim any available exclusions on their tax return. You are representing a buyer who learns a week before closing that the seller is a foreign citizen who does not live in the United States. The buyer is worried about FIRPTA and asks if they can ignore it because the property is going to be their vacation home and they are paying cash. What should you tell them? Suggested answer: you should explain that FIRPTA is federal law and that the buyer is usually the withholding agent. If the seller is a foreign person and no exception applies, the buyer is responsible for making sure the required withholding is done. Being a cash buyer or using the property as a vacation home does not automatically avoid FIRPTA. You should immediately involve the settlement agent and encourage the buyer to consult a tax professional so that the correct withholding or exception documentation is in place before closing. A new agent on your team thinks recording is just a formality because everyone knows who owns the house anyway. How would you use the Billy and Sarah example to explain the importance of recording and constructive notice? Suggested answer. You might explain that without recording, there is no reliable system to prove ownership if disputes arise. If the seller gave one deed to Billy and another to Sarah, recording is what allows the law to decide who has priority. Once Billy's deed is recorded, the world, including Sarah, is deemed to have notice of Billy's rights. Recording protects buyers, lenders, and the market by creating a public record that can be checked before money changes hands. It is far more than just a formality. It is a core part of how our property system functions. You are reviewing a closing file and notice that the deed was signed 3 weeks ago, but has not yet been sent for recording. What risks should you be thinking about? And what steps would you take as the broker or supervising agent? Suggested answer. You should recognize that delaying recording leaves the buyer exposed. Another lien, judgment, or even a fraudulent deed could be recorded in the meantime, creating priority issues. As a supervising broker, you would want to contact the settlement agent or whoever is responsible for recording and get a clear explanation. If necessary, you would push to have the deed and related documents recorded immediately and document your efforts. You might also review your office procedures to ensure that such delays are not caused by your own staff or processes. Closing remarks. Reporting and recording may not be the most glamorous parts of a real estate transaction, but they are essential to its legal and financial integrity. Federal forms like 1099-S and information returns for commissions let the government track taxable events. Special regimes like FIRPTA ensure that foreign sellers pay their share of U.S. tax on gains from U.S. real estate. Recording deeds, mortgages, and satisfactions in the county records gives the world notice of who owns what and which liens stand ahead of others. As a real estate professional, you are not expected to perform the work of a tax attorney or county recorder, but you are expected to recognize when these rules apply, to coordinate with title and escrow, and to guide your clients toward competent advice when needed. Mastery of these reporting and recording concepts adds another layer of professionalism to your practice and helps you shepherd transactions from offer to recording with fewer surprises.